What's going on with the crypto markets lately? If you've been keeping an eye on things, you've probably noticed a lot of red, right? Bitcoin, the king of all cryptos, has taken quite a nosedive, and it's got everyone buzzing. Is this the end of the bull run? Or is it just another wild Tuesday in the crypto world? Today, we're diving deep into the reasons behind this massive Bitcoin sell-off, sorting out the facts from the fear, and figuring out what it could mean for the future. So grab your favorite drink, get comfy, and let's jump into this crypto chaos together. Let's kick things off by addressing the big elephant in the room: profit-taking. After hitting some spectacular all-time highs, it's totally natural for long-term holders to want to cash in on their gains. I mean, think about it. People who bought Bitcoin years ago have seen life-changing returns. When the price hits a new peak, a wave of selling is almost guaranteed. It's not that these folks are losing faith in Bitcoin. They're just cashing out some of those sweet profits. This initial sell-off from seasoned investors creates a bit of downward pressure on the price. And when the price starts to dip, it can set off a chain reaction. You feel me? Now let's chat about market sentiment and panic selling. Crypto markets are notorious for being driven by emotion, and the fear and greed index is a perfect example of this roller coaster. When prices were soaring, the index was showing extreme greed. Everyone was jumping in, terrified of missing out on the next big thing. But as soon as the price began to drop, that greed flipped to fear faster than you can say hodl. Newer investors who might not be used to Bitcoin's infamous volatility see their portfolios shrink and start to panic. They sell to cut their losses, which pushes the price down even further, causing more people to freak out and sell. It's like a classic snowball effect, right? This panic is often cranked up by dramatic headlines and social media chatter, creating a feedback loop of negativity that can be super hard to break. Now let's zoom out and look at the bigger picture: macroeconomic factors. The global economic landscape has been shaky, to say the least. We're dealing with persistent inflation, worries about rising interest rates, and general economic uncertainty. When the economy feels unstable, investors tend to get more risk-averse. They move their money out of what they see as high-risk assets, like cryptocurrencies, and into safer havens like bonds or cash. This risk-off sentiment hits Bitcoin hard. Central bank policies, especially from the Federal Reserve, play a huge role here. Any hint of tightening monetary policy can send shockwaves through the crypto market, as investors brace for less easy money flowing into speculative assets. On top of those economic worries, let's not forget about geopolitical tensions. Conflicts and instability in various parts of the world, like the ongoing issues in the Middle East, make global markets jittery. Investors hate uncertainty more than anything else. Geopolitical events can disrupt supply chains, impact energy prices, and create a general sense of unease. This prompts a flight to safety. While some argue that Bitcoin is a safe haven asset like digital gold in times of broad market panic, it often behaves more like a high-risk tech stock, selling off along with everything else. This instability adds another layer of fear, encouraging investors to de-risk their portfolios, which often means selling Bitcoin. Now, let's dive into another massive factor that can really accelerate a downturn: leverage and liquidations. In the crypto world, many traders use leverage, which means they borrow funds to amplify their trading positions. For example, with 10x leverage, a 1% move in the market becomes a 10% gain or loss. While this can lead to huge profits when the market is up, it's incredibly risky when it goes down. As Bitcoin's price started to fall, many of these leveraged long positions became unprofitable and were automatically closed out or liquidated. This forced selling of massive amounts of Bitcoin onto the open market in a super short time frame. This flood of sell orders creates a liquidation cascade, pushing the price down even more sharply and triggering even more liquidations. We saw billions of dollars in long positions wiped out, which dramatically intensified the sell-off. And we can't overlook the technical side of things either. Chart analysts, or technical analysts, look at price patterns and indicators to predict future movements. Before this recent drop, several bearish technical signals started flashing. You might have heard traders talking about a death cross. This occurs when a short-term moving average, like the 50-day, crosses below a long-term moving average, like the 200-day. Historically, this has often been seen as a signal of a potential longer-term downtrend. When multiple technical indicators align to suggest a downturn, it can become a self-fulfilling prophecy. Traders who follow these signals will start selling or opening short positions, adding to the downward momentum. It's like a domino effect, where one signal leads to another, and before you know it, the market is in freefall. Plus, there are some fundamental, albeit smaller, technical issues within the Bitcoin network itself that can shake confidence during high-traffic periods. When the market is volatile, transaction volumes can spike. This can lead to network congestion, resulting in slower transaction speeds and higher fees. For users trying to move their Bitcoin to an exchange to sell quickly, these delays can be incredibly frustrating. While long-term solutions like the Lightning Network are in the works to address this, these periods of congestion can temporarily shake confidence and add to the negative sentiment surrounding the asset. It highlights the ongoing scalability challenges that Bitcoin still needs to overcome. So with all this doom and gloom, is it all bad news? Not necessarily. It's super important to put these market movements into perspective. Bitcoin has a long history of dramatic bull runs followed by significant corrections. In fact, pullbacks of 30 to 40% are quite common even within a larger bull market. Many experienced analysts and investors view these periods as healthy adjustments. They wash out the excess speculation, get rid of over-leveraged traders, and allow the market to build a more solid foundation for the next leg up. It's like a reset button. These dips can also present buying opportunities for those with a long-term conviction in the technology and its value proposition. When the panic subsides, the investors who believe in the fundamentals often step in, accumulating coins at what they see as a discount. Think of it this way: it's like a forest fire. While it's destructive in the short term, it clears out the dead wood and underbrush, allowing for healthier, stronger growth in the long run. The same principle can be applied to market corrections. They're a natural and necessary part of a free market cycle. The key is to understand the forces at play and not let fear dictate your decisions. Zooming out on the price chart shows that despite these massive drops, Bitcoin's long-term trajectory has consistently been up and to the right. Each cycle has brought higher highs and, importantly, higher lows. So, what should you do? That's a decision only you can make based on your own financial situation and risk tolerance. But here's the takeaway: the recent Bitcoin sell-off wasn't caused by just one thing. It was a perfect storm of long-term holders taking profits, macroeconomic fears, geopolitical uncertainty, and a massive cascade of leveraged liquidations, all amplified by panic selling. While it feels chaotic, many see it as a necessary market correction rather than a fundamental flaw in Bitcoin itself. It's a stark reminder of just how volatile this asset class can be. As always, do your own research, never invest more than you're willing to lose, and try to look at the big picture. The crypto coaster is a wild ride, but understanding the mechanics behind the drops can help you navigate it with a clearer head. Thanks for sticking with me through that deep dive. I hope this explanation helped you make more sense of the recent market madness. If you found this video helpful, do me a huge favor and hit that like button and subscribe to the channel for more content like this. I'd love to hear your thoughts in the comments below. Are you buying the dip, holding on for dear life, or staying on the sidelines? Whatever it is, let's chat about it. Stay safe out there, and I'll catch you in the next video.